all the day the market blinked. Stop scrolling. Because what just happened in the metals market is not a pullback. It's not profit taking. It's not healthy consolidation. It's something else. Gold didn't just slip. It rejected a major level and then collapsed through multiple supports like they weren't even there. Silver didn't correct. It unraveled. And when silver unravels this fast, it's rarely about silver. It's about liquidity. Let me explain something most people miss in moments like this. When assets that are supposed to be safe start falling at the same time risk assets are falling, you are no longer in a normal market cycle. You are in a liquidity event, and liquidity events do not behave rationally. They behave violently. The illusion of strength. Just days ago, sentiment was euphoric. Gold was pushing higher. Silver had momentum. Analysts were talking about breakout confirmations. Traders were front-running resistance levels. Everyone believed the floor was strong, until it wasn't. Here's the thing about markets. Support levels don't fail gradually. They hold, they hold, they hold, and then they snap. And when they snap in a leveraged environment, they don't break. They cascade. That's what this feels like. Not weakness, not doubt. A cascade. What a cascade really means. A cascade is not caused by people calmly deciding to sell. It is caused by people being forced to sell. There is a massive difference. In voluntary selling, investors reassess, reduce exposure, and wait. In forced liquidation, positions are dumped at market price with no negotiation. It doesn't matter what the asset is. It doesn't matter what the fundamentals say. It doesn't matter if war is expanding, oil routes are tightening, or inflation risks are rising. When margin calls hit, everything becomes inventory, and inventory gets liquidated. This is why you can see gold falling on a day when geopolitical tensions are rising. This is why you can see silver collapsing even when industrial demand remains tight. Because, in the short term, positioning overrides narrative. The leverage multiplier silver is not just a precious metal, it is a volatility amplifier. When gold moves, silver exaggerates. If gold gains 3%, silver might gain 8%. If gold drops 5%, silver can fall 15%. This is not manipulation by default. This is structure. Silver markets are thinner. Positioning is more aggressive. Speculative exposure is higher relative to physical flow. That creates leverage on top of leverage. And when that leverage unwinds, the speed shocks people. But here's the critical detail. Fast drops don't automatically mean fundamentals changed. They often mean leverage changed. And leverage can flip in hours. The silent signal. Nobody is watching. While everyone is staring at price charts, something else tends to move quietly in the background during these events. Short-term funding markets. When banks, funds, or large institutions suddenly need cash, they don't go to Twitter, they go to liquidity facilities. They tap short-term borrowing mechanisms. They raise collateral. They reduce exposure. And that process creates pressure across asset classes. If you ever see metals down, equities down, crypto down, and bonds unstable at the same time, ask yourself one question. Who needs cash right now? Because synchronized selling rarely comes from fear alone. It comes from necessity. Why this doesn't match the headlines. On the surface, none of this makes sense. Geopolitical tensions are elevated. Energy shipping routes are under pressure. Political rhetoric is escalating. Global supply chains are fragile. Historically, those conditions support gold. Yet price is falling. That disconnect is the tell. When reality and price move in opposite directions, either reality is wrong or positioning is being reset. And positioning resets are brutal. They are mechanical. They ignore logic. They override emotion. They don't care about narratives. The psychology trap. Here's how this usually plays out. First, the rally builds confidence. Then the pullback creates doubt. Then the bounce restores hope. Then the breakdown destroys conviction. That cycle is powerful because it conditions participants to buy dips aggressively until the dip doesn't recover. When that happens, optimism turns into urgency. Urgency turns into liquidation. Liquidation turns into acceleration. Acceleration turns into panic, and panic feeds price. This is how waterfalls form. Not because everyone changes their long-term view overnight, but because short-term pressure forces short-term exits. Historical context matters. Go back and study every major precious metals shakeout. 2008. During the global financial crisis, gold initially dropped hard while the banking system was imploding. Not because gold failed as a safe haven, but because funds were liquidating everything to survive. 2011, silver surged toward historic highs and then collapsed rapidly when margin requirements increased and leverage unwound. 2020, in the early pandemic panic, gold and silver both sold off alongside equities as cash demand spiked across the board. In every one of those moments, the drop felt final. In every one of those moments, commentators declared the thesis broken. And in every one of those moments, once forced selling ended, metals repriced higher over time. That does not mean every dip instantly reverses. It means liquidation events are often temporary dislocations, not permanent verdicts. The difference between paper and physical, another layer, people misunderstand during volatility. Like this is the distinction between paper markets and physical supply. Futures contracts can be liquidated in seconds. Physical metal cannot. Paper pricing is highly sensitive to leverage and momentum. Physical markets respond to longer-term supply-demand realities. When volatility spikes, futures pricing can overshoot dramatically. That does not automatically mean vaults emptied or demand disappeared. It often means positioning got too crowded on one side. And crowded trades unwind violently. The bigger question, so what is this? Is it the beginning of a prolonged bear cycle, or is it a leverage flush inside a larger structural trend? The answer doesn't reveal itself in one session. It reveals itself in behavior. Does price stabilize and compress? Do daily ranges shrink? Does volume decline on further downside attempts? Do funding markets calm? Those are the clues. Bottoms are not marked by headlines. They are marked by exhaustion. Why timing is dangerous here is where most people make their mistake. They try to predict the exact bottom. They try to catch the knife. They try to declare the all clear too early. Liquidity events don't end because we want them to. They end when forced sellers are finished. And forced sellers finish when either they have raised enough cash or there's no one left to liquidate. Until then, volatility stays elevated, and elevated volatility punishes leverage. The reality. Check if you're watching this unfold and feeling unsettled. That's normal. Rapid price movement challenges conviction, but conviction should be based on structure, not speed. Ask yourself, has global debt suddenly shrunk? Has geopolitical tension vanished? Has industrial demand for silver evaporated overnight? Have central banks reversed course completely? If the structural answers haven't changed, then the immediate explanation is likely mechanical, not fundamental. That doesn't remove risk, it reframes it. The signal to watch. Next, right now, the most important thing isn't the intraday chart. It's stabilization behavior. True stabilization looks like this. Price phi ND is a zone and defends it across multiple sessions. Selling pressure weakens, volatility compresses. Correlations begin to break apart. When everything falls together, it's liquidity stress. When assets start differentiating again, it's normalization. We are not there yet, but that is what marks the transition. The hidden advantage of liquidity? When everything is selling at once, most participants feel trapped. Retail traders panic. Leveraged funds scramble, short-term speculators get wiped out, but institutions with large cash reserves don't panic during liquidity events. They prepare for them. Liquidity events are clearance sales for those who don't need immediate liquidity. Let me say that again. When cash becomes scarce, the most powerful position in the market is having cash. Not because you believe in a narrative, but because you can wait. In every historical crash, the same pattern emerges. Leveraged players are forced out. Overexposed funds reduce risk. Short-term traders exit emotionally. Long-duration capital accumulates quietly. The headlines scream chaos. The balance sheets of patient capital expand. The institutional playbook. There is a difference between reaction and strategy. Reaction is selling because price is falling. Strategy is understanding why it's falling. Large institutions study positioning data obsessively. They watch open interest levels, options exposure margin utilization, funding stress indicators. When positioning becomes crowded on one side of a trade, institutions know the structure is fragile. Fragility doesn't mean wrong, it means vulnerable, and vulnerable structures collapse quickly when pressure builds. If too many traders are long using leverage, a relatively small trigger can start a chain reaction. Price drops, stops trigger, margin calls accelerate, liquidations cascade, and the very speed of the move scares others into selling voluntarily. That's when strong hands step in, not at the top, not during euphoria, during forced exits. The difference between panic and exhaustion panic is emotional. Exhaustion is mechanical. They look similar on a chart. Long red candles, high volume, wide ranges. But they are different internally. Panic is fear-based selling. Exhaustion is when there is simply no one left who needs to sell. Markets don't bottom when people feel comfortable. They bottom when forced sellers run out of inventory. That's why violent crashes often end quietly. Not with fireworks, but with silence. Volume fades, ranges shrink, volatility compresses. That's not boredom, that's balance returning. Systemic stress or cyclical flush. Here's the critical distinction we need to make right now. Is this systemic stress, or is this a cyclical leverage reset? Systemic stress looks like banking insolvency risks, credit markets, freezing payment systems failing, counterparty distrust, cyclical flushes look like. Overcrowded trades, unwinding leverage, resetting risk exposure, normalizing volatility, spiking temporarily. The surface can look similar, but the underlying structure is completely different. If credit markets continue functioning, if funding mechanisms remain open, if institutions are raising cash without triggering counterparty failures, then what we're seeing is likely a reset, not a collapse. That doesn't make it painless, but it changes the long-term implications. Why precious metals get hit? First, it sounds counterintuitive. Gold is considered defensive. Silver has strong industrial demand. So why do they drop hard during liquidity events? Because they are liquid. When funds need cash quickly, they sell what they can sell, not what they want to sell. Highly liquid assets become the first source of emergency funding. It's not ideological, it's mechanical. That's why you can see safe havens fall during early crisis phases. It's not a rejection of their long-term value. It's a short-term funding solution. Later, when forced selling ends, their original purpose reasserts itself. But timing matters, and forced liquidations don't reverse on command. The role of volatility is not just movement, it's information. High volatility tells you there's disagreement. Extreme volatility tells you positioning was imbalanced. But here's what most people miss. Volatility spikes before stabilization, not after. The final stage of a liquidation event often includes 1 or 2 massive range days, a failed breakdown attempt, aggressive intraday reversals. That's because short sellers start covering, buyers begin testing, and forced sellers slow down. Markets don't go from chaos to calm in a straight line. They transition through turbulence, the wealth transfer effect. Every liquidity cascade redistributes assets. Those who used leverage lose optionality. Those who preserved capital gain flexibility. The shift is subtle but powerful. During euphoric rallies, leverage creates the illusion of accelerated wealth. During crashes, leverage reveals its cost. Capital without leverage survives longer. And survival in financial markets is the ultimate edge, because if you survive volatility, you can participate in recovery. If you don't survive, the recovery belongs to someone else. What comes after the flush? Historically, major liquidity events in metals follow a recognizable arc. Acceleration phase, rapid downside movement, margin calls trigger, volatility explodes. Disbelief phase, participants expect immediate rebound. Bounces fail. Exhaustion phase, selling pressure weakens, price stabilizes sideways. Repricing phase, fundamentals reassert, longer-term trend resumes. The length of each phase varies, but the structure is consistent. The biggest mistake investors make is assuming phase 1 is the final verdict. It's not. It's the reset. Watching the right indicators. Instead of obsessing over every tick, watch structure. Ask, are daily lows getting aggressively defended? Is downside follow-through shrinking? Are correlations breaking apart? Is volatility compressing after expansion? Those are signs the cascade is losing force. Not tweets, not headlines. Structure, markets whisper before they shout. The psychological reset. There's another layer to this that matters deeply. Every crash resets psychology. Confidence gets recalibrated, greed cools, overconfidence dissolves. That reset is healthy in the long term. Unsustainable rallies build fragility. Fragility demands correction. Correction rebuilds durability. Without periodic flushes, trends become unstable. Volatility cleanses excess. It's painful, but it restores balance. The strategic question, so here's the real question moving forward. Are you reacting to price, or are you evaluating structure? Because reacting to price alone creates emotional decision-making. Evaluating structure creates strategic positioning. Liquidity cascades feel apocalyptic in real time. They always do. But once the forced component burns out, markets re-anchor to fundamentals, and fundamentals don't change in a single session. The final layer, patience as an edge. The rarest trait in financial markets is patience. Not prediction, not aggression. Patience. Liquidity events reward patience more than brilliance, because brilliance often expresses itself through leverage, and leverage struggles during volatility. Patience preserves optionality. Optionality captures opportunity. That's the cycle. Closing thought. Right now, the market feels unstable. That's because positioning is unstable. But instability does not equal collapse. It equals transition. The real signal won't be found in dramatic candles. It will be found in stabilization, when price stops accelerating, when volatility contracts, when forced selling fades. That's when the next chapter begins. And the next chapter rarely looks like the last panic, because once leverage resets, the market breathes again.